Everybody, Scott Sachs with the Synergy Group. Everyone is talking about it, the 50-year mortgage. Why are we even talking about a 50-year mortgage? Number one, housing affordability. If it wasn't for housing affordability being an issue in the United States, we wouldn't be talking about a 50-year mortgage. They actually exist. They actually exist with small privatized lenders that will do a 50-year mortgage. But generally speaking, Fannie, Freddie, and other institutions won't touch it. Does it actually make housing more affordable? Not going to get into the affordability crisis. I've done a video about that. That's a whole separate issue. Today, we're just discussing how does a 30-year mortgage compare to a 50-year mortgage. Now, let's get into the numbers a little bit, and then we can dissect it on the other side. So let's assume, for this example, a 30-year mortgage versus a 50-year mortgage with the following assumptions. A $900,000 purchase price, a 20% down payment, so you're doing an 80% loan to value at whatever the prevailing market rate is, okay? I see a lot of people posting examples of a 30 versus 50-year mortgage, and they're using the same interest rate across both products. It doesn't work that way. The same way a 5-year adjustable rate mortgage has a lower rate than a 7-year, that has a lower rate than a 10-year, that has a lower rate than a 30-year. Do you get the idea? It's because the bank has to secure the risk on their side of rates going up, right? So they secure you a 50-year rate at 6%, and then rates go to 8%, they're losing out on 200 basis points, and they have to basically deploy that risk across the yield curve. That's how it works. So in this example, we're going to use 6.5% on the 30-year, and we're going to use 7% on the 50-year, okay? That's probably within range. 50 to say 75 basis point spread between a 30-50 is probably where it might shake out. So what does that actually look like? Here's a chart of the numbers. So if you assume those terms, the amortization, the actual payment amount on the 30-year is $4,550 a month. Now we are stripping away taxes and insurance because we are really only interested in the mortgage interest and principal pay down over the course of that term. The 50-year mortgage payment is $4,260 a month. When comparing the two, your delta, or the difference between these payments, is $290 a month. So one might say, okay, I'm saving $290 a month going with a 50-year mortgage product. Why wouldn't I do that? Well, let's get into the numbers further on how the amortization project actually works. Let's assume roughly a 10-year holding period for this asset. Now, the national average for how long you own a home is between 7 and 10 years. It fluctuates. So already you have a knock against the 50-year amortization because it's going to be so heavily interest laden on the front end of that product that you're really not paying down that much principal. And here's an example. Your starting balance on the loan is $720,000. By year 10, the remaining balance on a 30-year is $572,000. The remaining balance on a 50-year is $681,000. That's a delta of over $110,000. The principal paid down during that period is $148,000 on the 30-year and only $39,000 on the 50-year. So what does all this mean? The amount of interest that you pay on the front end of this thing. By year 10, okay, going back to this chart, the year 10, you've only paid down 5% of the principal on the loan balance. So if it's only 5% and the value of your house goes down 5%, how much money are you getting in equity after 10 years of holding a 50-year mortgage? You're getting nothing back. And that doesn't factor in the transaction costs of the deal. But let's go a step further. Now let's assume you say, well, Scott, I'm a savvy investor. I'm going to take the 50-year mortgage and I'm going to take the $290 that I save and I'm going to invest it every month. Now, don't tell me this, I'm going to put it into crypto and I'm going to make 20% 8% a month or annualized, let's assume some very reasonable figures. Let's assume you take the $290 and you invest that in a mechanism that gets you 8% annualized, which is still exceeding any type of money market account, bond, treasury, etc., and just below this year's performance of the equity market. So let's assume that 8%. What does that look like over a 10-year holding period? And assuming 4% annual property appreciation. After 10 years, we have a property value of $1,332,000. The remaining loan balance on the 30 years is $572,000. The remaining loan balance on the 50 years is $681,000. The home equity appreciation plus principal paid on the 30 years is $760,000, and the home equity on the 50 is $651,000. The 30-year borrower has $109,000 more equity after 10 years due to faster amortization. Now, with the investor growth model on the monthly savings at $290, invested monthly at 8% annualized, over 10 years, the future value of this payment, that's 120 periods, is $52,500. This amount partially offsets that deficit, but remember, you are $109,000 behind in 10 years on the 50-year versus 30-year. Even with the additional $52,500, you are still almost $60,000 behind in equity, assuming you got that 8% gain. What does this mean? It means don't do a 50-year mortgage. Find a way to afford the product you're buying within a 30-year amortization package, meaning find a professional who's going to look out for your best interests, who breaks down these numbers so that you can understand them and unpacks them in a meaningful way so that you're making smart financial decisions about real estate and what's happening outside of real estate so that you are being fiscally responsible. Talk to a real estate professional who understands this, who understands how amortization really works, and isn't pushing you into one of these 50-year products, knowing that it's really not in you, the consumer's best interest. For more information, visit synergysoldit.com. This is a lot of information. I'm going to post all of this to this video below, and we're also going to have it on our website, readily available with a full breakout and stats of a side-by-side T-chart comparison of a 30-year amortization and a 50-year amortization. And then, like I talked about, bringing in that assumption of you reinvesting this at an 8% annualized return. These are very reasonable numbers and assumptions to give you that side-by-side comparison. If you have questions or you're interested in talking to myself or one of our associates for more investment advice on how to either buy your first home or an investment, visit synergysoldit.com.